The impact of the global economy on gold prices. Gold has long been considered a safe haven asset, often thriving during times of economic uncertainty. Its price is influenced by a wide range of global economic factors, and understanding these relationships can provide insight into how gold performs in different market conditions. Key elements that affect gold prices include inflation, interest rates, and economic crises. 1. Inflation and gold prices. Hedge against inflation. One of the most well-known relationships is between gold and inflation. When inflation rises, the purchasing power of paper currency decreases. Investors tend to turn to gold as a hedge against inflation because it retains its value over time, leading to increased demand and, consequently, higher prices. Historical performance. Historically, during periods of high inflation, gold has seen upward trends. For example, during the 1970s, gold prices surged in response to double-digit inflation rates in the U.S. 2. Interest rates and gold. Inverse relationship. There is generally an inverse relationship between interest rates and gold prices. When central banks, like the Federal Reserve, increase interest rates, the opportunity cost of holding non-yielding assets like gold rises. This often leads investors to sell gold in favor of assets that generate returns, such as bonds, causing gold prices to fall. Low interest rate environments. Conversely, in a low interest rate environment, gold becomes more attractive as an investment. Investors are less concerned about the opportunity cost of holding gold, which can lead to a rise in demand and prices. The 2008 financial crisis and the subsequent near-zero interest rate policies are a prime example of how gold can benefit in such scenarios. 3. Economic crises and gold prices. Safe haven asset. During times of economic instability, whether caused by geopolitical events, stock market crashes, or financial crises, investors flock to gold. This is due to gold's reputation as a reliable store of value when other assets, such as stocks and currencies, lose value. During the 2008 financial crisis, gold prices soared as investors sought refuge from the collapsing stock market. Currency fluctuations. Economic crises often lead to significant currency fluctuations. When a country's currency weakens, gold prices, which are typically priced in US dollars, may rise in that currency. For example, during currency devaluations or hyperinflation, gold becomes a critical hedge for preserving wealth. 4. Global monetary policy and gold. Central bank reserves. The monetary policies of major economies, particularly those of central banks, play a significant role in gold prices. Central banks hold large reserves of gold as part of their monetary policy to balance and stabilize currencies. Changes in these reserves can signal shifts in demand and supply, which may influence gold prices. Quantitative easing. When central banks adopt expansionary monetary policies, such as quantitative easing, QE, to stimulate their economies, it can lead to a rise in gold prices. QE increases the money supply, often leading to fears of inflation, which, in turn, boosts the demand for gold as an inflation hedge. 5. Global trade and political tensions. Geopolitical uncertainty. Tensions between countries, such as trade wars, military conflicts, or political instability, can drive up the price of gold. Investors view gold as a safe harbor during periods of uncertainty, where the stability of global markets is in question. Trade and tariffs. Trade policies, especially between major economies like the US and China, can also impact gold prices. For instance, during the US-China trade war, gold prices increased as investors became concerned about the global economic repercussions. Conclusion. Gold's relationship with the global economy is complex and influenced by a range of macroeconomic factors. Inflation, interest rates, economic crises, and global monetary policies all play critical roles in determining the price of gold. During times of economic uncertainty, investors often turn to gold as a reliable store of value, which can drive its price upward. Understanding these dynamics is essential for investors looking to hedge against risk or capitalize on gold's movements in response to the global economy. The future of gold in the age of cryptocurrencies. The rise of cryptocurrencies, particularly Bitcoin, has sparked debates about the future of traditional assets like gold. Both gold and Bitcoin are seen as alternatives to fiat currencies, offering investors a hedge against inflation and economic uncertainty. However, the rapid growth of digital currencies has led some to question whether gold's position as a safe haven and store of value is at risk of being undermined by these newer, more innovative assets. Gold versus Bitcoin. Similarities and differences. Store of value. Both gold and Bitcoin are often considered stores of value, providing a way to preserve wealth during periods of economic instability. Gold has held this role for thousands of years, while Bitcoin, introduced in 2009, is much newer but has gained a significant following due to its decentralized nature and limited supply. Finite supply. One of the key similarities between gold and Bitcoin is their limited supply. Gold is a naturally occurring metal, and the quantity that can be mined is finite. Similarly, Bitcoin's supply is capped at 21 million coins, a feature built into its blockchain technology. This scarcity has been a significant factor driving demand for both assets. Medium of exchange. While gold has historically been used as a medium of exchange, it is now primarily an investment asset. Bitcoin, on the other hand, was created as a digital currency for peer-to-peer transactions, though its volatility has hindered widespread adoption for everyday payments. Bitcoin's disruption of gold's role. Millennial interest. One of the reasons Bitcoin is seen as a potential threat to gold is the growing interest among younger investors. Millennials and Gen Z, who are more tech-savvy, tend to favor digital assets like cryptocurrencies over traditional investments like gold. This shift in investor preferences could, over time, reduce demand for gold. Digital innovation. Bitcoin's appeal also stems from its technological innovation. Blockchain technology provides transparency, security, and decentralization, making Bitcoin attractive to those who distrust traditional financial systems. Gold, while a physical asset, lacks these technological benefits and might be perceived as outdated by some investors. Gold's enduring appeal. Historical trust. Despite Bitcoin's rise, gold's long history and established trust cannot be ignored. Gold has been a reliable store of value for thousands of years, surviving numerous financial crises, wars, and shifts in global economies. Its physical presence and tangibility provide a level of security that digital assets, which exist only electronically, may not offer. Stability versus volatility. Gold is also much less volatile compared to Bitcoin. While Bitcoin has seen wild price swings, gold's movements are relatively steady, making it a safer option for conservative investors. This stability reinforces gold's role as a hedge during economic downturns, while Bitcoin's volatility might make it less suitable for this purpose. Diversification. Gold and cryptocurrencies coexisting complementary assets. Many financial experts believe that gold and Bitcoin can coexist as complementary assets in a diversified portfolio. While gold offers stability and a proven track record, Bitcoin provides high risk, high reward potential. Some investors see value in holding both, using gold as a hedge against market risk and Bitcoin as a speculative investment with the potential for significant returns. Digital gold narrative. Bitcoin is often referred to as digital gold due to its properties of scarcity and decentralization. However, the narrative doesn't necessarily mean that Bitcoin will replace gold. Instead, it highlights the fact that both assets share characteristics that make them attractive as stores of value, albeit in different ways. Regulation and adoption. Government regulation. One of the key challenges facing cryptocurrencies is regulation. Governments around the world are still grappling with how to regulate Bitcoin and other digital currencies. Increased regulation could impact Bitcoin's value and its appeal as an investment. Gold, on the other hand, is already well regulated and understood by investors globally, giving it an advantage in terms of stability and predictability. Institutional adoption. Another factor to consider is the growing institutional adoption of Bitcoin. Large financial institutions and companies, such as Tesla and MicroStrategy, have added Bitcoin to their balance sheets, lending credibility to the cryptocurrency market. While this adoption is still in its early stages, it signals that Bitcoin is being taken seriously by mainstream financial players, potentially increasing its competition with gold. The future outlook. Safe haven status. While Bitcoin has gained significant traction, gold's role as a safe haven asset is unlikely to disappear anytime soon. The two assets cater to different types of investors and market conditions. Gold remains a reliable choice for those seeking stability, while Bitcoin appeals to those looking for high-risk, high-reward opportunities. Evolution of digital assets. The future may see further evolution in the cryptocurrency space, including the development of more stable digital assets or central bank digital currencies, CBDCs, which could challenge Bitcoin's dominance. However, these innovations may not necessarily replace gold but rather expand the range of options available to investors. Conclusion: gold and Bitcoin represent two different generations of assets, each with its unique advantages. While Bitcoin has introduced a new form of decentralization, digital value storage, gold's long history and stability ensure its continued relevance. Rather than replacing gold, Bitcoin is more likely to coexist as part of a diversified investment strategy, offering investors exposure to both traditional and emerging forms of wealth preservation.